I would like briefly to present our panelists, and then each of them will present their background. We will start with Stephen Robinson to my left from McFarland's. Then Jacques Lilly will speak from the European Investment Fund, going to the end of the table. And finally, Robert Luke from GED Capital Development. So without more ado, Stephen.
Good morning, ladies and gentlemen. My name is Stephen Robinson. I am a partner in the investment funds group at McFarland's, which is a major London law firm. One of the main practice areas, sorry, just trying to get this slide to work. McFarland's is a major London law firm, and one of the main practice areas is private equity, both on the transactional side for a lot of private equity and venture capital houses, and also my area is particularly raising private equity and venture capital funds for a mixture of general partners throughout Europe, and that involves a full range of advising general partners on fundraising, on co-investment and carried interest schemes. So what I will be saying is a mixture of legal points, really my overview of current fund terms and conditions in the last couple of years, and just a few general observations about the state of the European private equity and venture capital market. So where are we now really in Europe? I think we're seeing a real diversification between the very large pan-European private equity players who are very established, have got a network of European offices, and in my view these have become very established, in fact sort of mini conglomerates. I've heard the term used. They're building up a huge base of assets, of portfolio companies. If you look at the number of indirect employees these private equity houses control, you're really running into the tens of thousands. So you've got a huge conglomerate-based approach at the high end of the market, the billion-pound, billion-euro funds, a lot of club deals taking place. And I think that trend is going to continue at the top end of the market, and more people are moving up the scale, I think, raising larger funds. We are still seeing a lot of the big US private equity houses investing a lot of time, a lot of money in building up pan-European networks. And I think that trend is going to continue. Certainly the US clients we're involved with are very bullish about the European market. I think there's a sense that the US market is very, very competitive, and the European market isn't quite as competitive yet. But saying that, there is increased competition, certainly in the big deals. There's a lot of people chasing the same deals. There's an awful lot of auctions going on in the UK and really all around Europe for the larger private equity transactions. There is, I think, a lot more fragmentation in the mid-market. And if you speak to different people, they have a different view as to what they actually mean by the mid-market. Some people say the mid-market is enterprise values up to 500 million euros. Some would say the mid-market is enterprise values up to €1 billion. So more fragmentation in the mid-market, and that gets us to the country-specific versus the pan-European funds, which I know we'll talk about shortly. Again, another trend we're seeing, I think, more realistic investor expectations on returns from private equity and venture capital. 3, 4, 5 years ago, when you read a PPM for a private equity fund, they all talked about achieving an IRR of 30% plus, and it would all be very easy. When I sort of read and help clients with PPMs these days for fundraising, they're saying our expectation is maybe 15 to 20%. And I think limited partners, investors are getting that message. It's going to be a lot harder, I think, to achieve the very consistently high IRRs maybe over the last few years. Which means I think private equity and venture capital firms have to work a lot harder to convince limited partners that it's a good asset class to be in. If you're only beating the public markets by maybe a few percentage points, you've really got to convince the LPs that it's a place to be. Obviously, the fees and the carry in investing in private equity is a lot higher than investing in the public markets. So I think GPs really are working a lot harder to get limited partners into their funds, which I don't think that's a bad thing. Certainly a big trend of this year, and I'm sure a lot of you have seen it, is debt is really falling out the banks. I mean, banks are really falling over each themselves to lend to the large private equity transactions. There's been a lot of discussion, a lot of debate about the impact of hedge funds converging into the private equity market, either as quasi-investors or more likely to be providers of debt. And there is, I think, increasing concern that some of the large deals are over-leveraged, and that could potentially come home to roost in the next 2 to 3 years. I think there is a big concern that a few deals just now are over-leveraged, and if they don't work out, there could be a lot of money lost amongst the LP community. This year, I think, has probably been the best year of realisations across Europe, certainly in the UK, and I think in France and Germany. There's been a run of very large realisations. Far more of our clients in the UK have been focusing on returning money to limited partners, and there's been some very good and big realisations this year, and I think that's obviously very good news for the private equity community and the limited partners, getting some money back for reinvestment. And everyone is now talking about an improving fundraising climate for 2005, 2006 in the UK and across Europe. There's meant to be an awful lot of the established players and some new players raising what could be quite substantial funds in the next year, in the next 2 years. And with a lot of money coming back to LPs and some new LPs looking at the market for the first time, it could be a very good fundraising climate, which should be good for everyone. And I think a more positive outlook than we've had for the last couple of years. Just some brief figures from EVCA. I think we're just trying to fix the IT.
Yeah, good.
That's far better. I don't think these figures should surprise everyone. Fundraising over the last few years, the peak in 2000, the height of the bubble, a lot of funds raised in private equity and primarily venture capital, and really a tailing off over the last couple of years. I think the figures for 2004 will probably be similar to the last couple of years. And I also think a lot of people who raised money in 2000 at that peak probably won't be around to raise another fund. I think there'll be a lot of consolidation, particularly amongst the VC market. It was far too easy to raise money in 2000. A lot of those VC houses have unfortunately lost quite a bit of money. So I think there'll be consolidation, there'll be a few people disappearing. And again, probably no bad thing for the long-term health of the market. And again, that slide just shows a split between captives and independent houses, and certainly a trend we see in the UK and across Europe is an increasing trend bias towards independent houses. LPs, large investors, really like independent private equity and venture capital houses. They are far more careful and unsure of investing in a captive or a semi-captive. And that's something I think we'll see continue. Investment figures, again, just a brief slide from EVCA. 2000, the boom, lots of VC investment, and a gradual tailing off to 2003. I think, again, 2004, much the same. There has been some investment activity, but 2004 has really been a year of exits, some of which will be secondary buyouts, and therefore you see the flip side. Some of which will be trade sales and 1 or 2 IPOs. And again, I think people are optimistic that deal activity is picking up across Europe for 2005. So current trends in the market. really from my view as an impartial legal observer sitting in London. As I said, a new wave of fundraising going to start next year, and I think that's going to be a mixture of venture capital. A few VC houses are coming back to the market, and the large pan-European funds as well. There are some new institutions, I think, looking at private equity for the first time. There's more money coming, I think, from the United States into Europe, from the LP community, than there has been for quite a long time. A lot of US investors, I think, really withdrew 2001, 2002, when the public markets tailed away. They are starting to look seriously again at private equity and VC investment in Europe. And there is an awful lot, there's far more money really in the United States. A typical US pension plan would invest maybe 20, 30 million euros in a fund. A UK or European pension plan would probably be investing maybe 5 to 10 million. So it's a very important market. But saying that, the fundraising climate, I think, is still very tough. Investors are a lot more demanding than they used to be. I think that's quite clearly the case. Fundraising is taking a lot longer to achieve. Investors are really taking a lot more time. They're doing an awful lot more due diligence than they ever used to, even on funds where they've invested in before. When I speak to GP clients, they get quite exasperated sometimes as to long-standing investors doing an awful lot of due diligence.
You want to take a question now or after?
At the end. We're a little short on time. So.
Investors really very demanding on due diligence, a lot of reference checking, coming in, spending days at the GP, and re-upping, even good quality GPs who are raising their third or fourth or fifth fund. It's not as automatic as it used to be that their current investor base will reinvest in their funds even if they know the team very well. I think a lot of investors have a far more sophisticated approach, and they really view successor funds as a first-time investment as well, and they'll do the same amount of due diligence, the same amount of checking as they would do as if they were investing for the first time. So being a lawyer, one of the things I said I would talk about briefly is my view of current terms. Where are we in the terms and conditions for private equity and venture capital funds? And I think the first thing to say is no matter how good or bad the terms are in the fund, they don't generate the returns. The returns are obviously generated by how good the private equity or venture capital house is, but terms are important. Limited partners are spending far more time looking at partnership agreements and placement memoranda than they used to do, and they're being far more careful in negotiating key points. Different LPs have a different focus on what they want in the terms of the fund. And looking at fees, I think, is obviously an important one. I don't think fees have actually changed that much in the last 5, 6 years. You still really see a range of 1.5% to 2.5%. The big funds, maybe 1.5% per annum on committed capital. There's talk of the £1 billion plus funds should be lowering their fees down to maybe 1% and below. But that's not really happened, and the LP community doesn't really seem to be pushing for that, or hasn't pushed hard enough for it. Carry and hurdle still a very conventional 80-20 split, and the vast majority of funds, VC and private equity communities, still have the 8% hurdle. Some are trying to get it a bit lower, but it's remarkably consistent. One real hot topic, I think, from the last 18 months in my experience has been abort fees and transaction fees. The bigger the transaction, the more transaction fees potentially earned by the private equity house as an arrangement fee, as an introduction fee. And these transaction fees can now run into millions of pounds and really equal or exceed the amount of annual fees they're getting out of the fund. So limited partners are really focusing on how these transaction fees should be split between the fund, i.e. the investors, and the general partner. And there's a lot of negotiation and a lot of movement, I think, on how transaction fees are dealt with in fund documentation. Termination rights, again, LPs are focusing particularly on what we call fault divorce and no fault divorce. In fact, I've seen this happen in a couple of funds over the last few years, the general partner being forcibly removed by unhappy limited partners. And what are the consequences when that happens? Should they still receive carry going forward? Should compensation be payable? And these issues weren't really around 4 or 5 years ago. LPs didn't really focus on getting rid of the GP if things didn't go well, but it's really high up their agenda now. Default and drawdown, again, has become more important for LPs to look at. There has, with the bubble and some LPs being in financial trouble, been more defaults, and therefore GPs focusing on what should happen to defaulting investors. You see a lot of preemption rights, you see a lot of forced sale procedures and fund documents now. Some GPs are reluctant to use them. GPs will try and sell the position on maybe to other investors in the fund. But we are seeing, I think, a trend from America, more litigation in this area, and I think that may well continue in the next few years. Non-economic terms, important. And I think just to flag up the first point in particular, there is a trend in European legislation and in US legislation towards freedom of information. In the UK, there's a new Freedom of Information Act, which comes into force the start of next year. And probably we've all read about the issues that US state pension funds such as CalPERS in California, UTIMCO in Texas have about public disclosure of investment records and the funds they've achieved. Some GPs are very wary about this and are trying to impose very strict confidentiality obligations in their partnership agreements. Some GPs aren't really that bothered about it and are quite happy for investors to disclose performance information. Less readily willing for information about portfolio companies to be made public. But there is a general trend to freedom of information in a legislative requirement. And certainly if you've got a state or local pension plan, they may well be under obligations to reveal more information than GPs think. New valuation guidelines from both the British Venture Capital Association last year and I think the first quarter next year from EVCA. More funds will be adopting standard valuation guidelines, but investors are far more, I think, interested in valuation. They take a far greater role in how the GP is using valuation methodology, and they expect that to be discussed at advisory committee meetings. And again, just to finish off, advisory committee, I think LPs are becoming more vocal in what the advisory committee should be doing, how often it meets, what its remit should be. Role in valuations, key man again, very important. I'm running out of time, so I will just speed on to my last slide, which was that.
Thank you.
EIF is it's a public-private partnership, mostly private with 60% European Investment Bank shareholding and 30% commission, and then a range of banks, primarily from the European Union. And we have three product lines. We are a European institution, which is quite an atypical animal in the institutional ecosystem, in that one, we're very small, we're 60, 65 people, and two, we have a profit motive. So that changes in a way what we do in relation to other better known European institutions. We have three product lines: VC, what we call SME guarantees, which is primarily complex securitizations in support of SME finance by large insurers and banks, and then advisory services. In VC, we're probably, let me see, how do I... Anyway, we're probably the biggest European early stage investor in the area of VC. We have, maybe we should show this, let me see. Yeah, we have some 3 billion invested in 200 funds since 1997. And we always participate as any other LP on paper, except that we typically invest earlier on in the process. And so we have been the cornerstone investor in I would say the cream of the crop in European VC from 1997. We've taken typically between 1/3 and 1/2 of the first closing of all the well-known names and some less well-known names. Whose money do we invest? We invest our own money, and also we are a fund of funds manager for the European Investment Bank, the European Commission, some European governments, the German government, and then we'll soon announce that we will become fund of fund investors for a large European bank. Now, yeah. Now this is, I won't go into too much detail on what was said before. This slide is here to indicate that we have to follow the market. And for example, in 2001 and 2002, when we actually wanted to invest, to deploy a lot of funding because we believed it was a good time to be investing, we made a number of commitments that we weren't able to close because the other LPs weren't there. So even though we try to take a differing view from what we see a little bit as a herding mentality in the market, we can only do so much. In 1999, we discontinued investing in internet. And at the time, biotech was not in fashion, and we started heavily investing in biotech. So that has helped us quite a bit in mitigating the impact of the bubble, the bursting of the bubble, that is. And in 2001 and 2002, we started investing in new materials, and so that begs the question: what are we trying to invest in now? And we could discuss about that. Let me see. Same numbers as before. I would make 3 comments as to the returns in this area, and that I think the industry is not either willing to understand or does not understand a number of things behind these figures. One is that, contrary to what you see in public markets, when you take an average, for example, I don't know, all private equity 10%, the dispersion relative to the mean is very significant. And so you see the top quarter is 24-25%. I'll let you imagine what the lowest quarter is. So that's quite a specific feature in private equity, which in my view takes away a lot of meaning from average figures in this area. And another issue is the illiquidity premium. Is that people tend to say, oh, this relative to investing over 15 years in Nasdaq or whatever is good or not good. There's a huge illiquidity premium, and the longer you go, if you look at figures for say 15 years, well, you've had money as an investor, as an institutional investor, you've had money blocked in these funds for 15 years. Whereas if you were an investor in the public markets, you actually can take it out anytime. You may have lost, but you can claim the value that you have. So that's quite a differing feature in this area, which is compensated by another factor, which is the diversification that this brings. It's difficult today for large pension funds, insurers, to find diversification once they've invested in public markets, a whole range of products. You're left with the non-typical, the non-quoted markets, and there they bring, if you look at a very large portfolio for a big insurer, 5% or 10% of investments in non-listed is actually a very welcome diversification. We have started an advisory activity a year ago, which is actually booming. It's becoming quite big, and which underscores that a number of investors, be it governments, regions, private sector, are actually seeking know-how as to how to invest in this area. There's a lot of disarray. Many people invested quite a bit in 2000. They got burnt. They know they have to invest in this area. but they don't actually know necessarily how to. The large ones are very sophisticated, the large insurers or pension funds. But then there's a range of people who will be investing in 5 or 10 funds over, say, 10 years, and it's quite a heavy investment up front for them to actually set up a team in-house and to both invest in these things, start the transactions, and also manage the risk that is associated with it, and monitor, and then when one of a fund has problems, then restructure them. And so they come to us, or we propose to them that we might manage some of that. So that's growing quite a bit. A number of examples of what we're doing is we're advising, for example, Andalusia in Spain, which is a 10 million region, that is to say twice the population of Norway or Denmark, in structuring their seed funds and development capital funds, since we've been advising them for a number of years. And so now they're in their 3rd generation VC funds. And we will soon be announcing the structuring of the 3rd fund. We've advised a number of regions. We also advise the European Union in complex financing structures. So I have 2 minutes. Thank you. 1 minute now. We advise on complex financial structures. We advise the Russian Federation and the European Union, for example, in how to finance the exportation of oil and gas from Russia to the European Union, with the target of having gas and oil prices listed in euros, and that's working quite well. Then we have quite a high-profile assignment with DG Research within the European Commission, which is we've taken a look at how clusters interact or don't interact in Europe, and how tech transfer works or doesn't work in Europe, and we've made a proposal for, I will call it a next generation of tech transfer seed funds. And that is attracting a lot of attention. It's a significant sum of money that we are getting to structure that, and that should be announced sometime in the springtime. We are now touring Europe and Japan, US, Israel to both collect ideas and arrange the fundraising of all this. And I think as we could discuss that later on, and I've made my time, I hope. Thank you.
Robert Luke.
Good morning. My name is Robert Luke. I'm the Managing Director of GED Capital Development, which is part of the GED Group. Over the 30 years I've been involved in private equity. The first 10 years or so was in the UK environment. I started working with 3i's and went on from there. The second 10 years was in a less developed private equity environment in Spain. And subsequently, the last 10 years or so, I've been working in Eastern Europe, concretely in a fund in Romania. Just very briefly, the way that we look at private equity, being a mid-market fund in less developed countries, both in Spain, where we have an 86 million euro fund, the IF being one of our major partners, and in Eastern Europe, in Romania, is that we believe that we need to become very involved in the management of the companies that we invest in. We are by no means hands-off investors, and later on in my presentation I'm being quite controversial, I hope, in trying to distinguish between what I think are the key success factors between pan-European funds and country or region specific. Our track record to date in very difficult circumstances in Romania is that we've exited from 5 of our 12, and we have a 27% gross IRR, which is in the region of 20% net. We are projecting for the whole portfolio 20% gross and about 15% net. That's been very much produced by the fact that of our 12 investees, we've not lost any of them. And that was the economy shrank by 20% over that period. Also the Russian markets collapsed and so on. It's been really quite difficult, but the important thing is that now we see very clearly a possibility of investing in pre-accession countries, Romania, Bulgaria. Hungary is obviously now in the EU, the ex-Yugoslav countries, and we're in the process of raising 120 million fund to cover those areas with that hands-on, in fact I'd prefer to say hands-in investment philosophy. I've tried to divide in the next two slides what I consider to be the characteristics of the pre-accession countries and the post-accession, in other words, those countries which are now in the EU, because I believe that LPs are taking different views now of funds covering those different regions. One question is whether those pre-accession funds which were investing in Poland, Czechia, before May of this year, whether the returns have compensated the perceived higher risks. Obviously, has been said, there's a wide range, but those successful funds which are in the market or have already raised further funds, successor funds, have clearly proven, yes, you can get higher returns to compensate the perceived higher risks. Now, admittedly, that is in development capital or MBO type funds. Venture funds are very, very difficult everywhere, but certainly in Central and Eastern Europe, where you do not have proven management capability. You have excellent technicians, but you have very poor managers. So certainly our philosophy for our second fund is that we're not going to touch venture. We will not be investing in startups. Now, long-term, structurally, there are some big questions as to how that's going to affect private equity over the next 10 or 15 years. Post-accession, very clearly, there's enough track record now for LPs to be looking to the flight to quality. They're all looking to get into the top quartile. That means that the good fund managers are in the luxurious position of being able to turn away investors. And that's likely to continue over the next 5 years, I would say, because there just are not enough fund managers with good track records. The specific markets are becoming more similar because they're now part of the EU. There isn't such a differentiation between investing in a Hungarian company or a Polish company or a Czech company. Although national characteristics are still important in terms of how the investee managements look at their companies and their role in the expanding markets. And it may be that for post-accession, a pan-European or pan-Central and Eastern European, but region-specific is the best answer. In the next couple of slides, I'm trying to, as I say, be controversial. Clearly, I'm not objective because I'm running or involved in the running of regional specific, Spain and Portugal on one side and Southeast Europe on the other, not pan-European. But I do feel that there are some advantages and disadvantages. Perhaps the key advantage of pan-European is that one can attract the top professionals, one can play with size, and one is able to establish brand recognition. However, it is not as easy to stay close to the investees if you're in London or if you're in Frankfurt, then obviously if you're on the ground. It's also, in practical terms, not possible to have offices in every country in which you might be investing. Therefore, it's more difficult to add value, and you're probably more likely to get into auctions because you're dependent on intermediaries than somebody who's closer to the ground. This is really the mirror image of what I put there before. In country specific, you're closer to where the action is. It is easier to get close to and work with investee management, and it's much easier to spot market dysfunctionalities. Disadvantage is a country or region specific, is that fundraising is more difficult. You haven't got such a wide population of potential investors. Return expectations are higher because of perceived risks. I'm not sure, frankly, whether those expectations that the risks are going to be higher are correct. From what Stephen was saying earlier, some of the higher pan-European LBO deals are really risky in the sense of they're really leveraged. And if the debt markets start going wrong, or if the economy goes through a slump, then I think it may be that LPs will realize that perhaps slightly less sexy but more traditional private equity deals in Eastern and Central European countries, in fact, are less risky than some of those deals. But that's just an opinion. My conclusion could be that the more sophisticated the sort of private equity investing one wants to do, the more likely it is that a pan-European fund is going to be able to do it well. Where hands-on value-added assistance is necessary, then I would suggest that one goes country-specific. And I'll stop there for questions because some of these slides are already repeated and they're in your books anyway. Thank you.
Thank you very much. We'll open the floor for, let's say, 2 or 3 questions, since we're running a little bit out of time.
Quick question for Stephen.
In terms of what are you observing in terms of the length of time it currently takes for a venture fund to raise a new product in Europe right now? I mean,
it's quite difficult to overgeneralize. I think they're spending a lot more time before they do their formal launch. They're spending an awful lot of time in working out what message they want to give to the market. I think more houses are now using placement agents and advisors than ever before. Whether that's good or bad, I sit on the fence, but there are more advisors and they are pushing them to do this or that and tidying up the message. So they're taking longer, I think, to launch. I think the key thing is the time between you actually start your formal launch period and the time you get to your first close, because you must really maintain the momentum from going out to launch to getting a first close within, I would have thought, a maximum 6 months, and then maybe another 12 months between first and final close. We have seen over the last 2 or 3 years people extend final closing periods up to 18 months, even 2 years after first close, but I think that's going to contract back in the next couple of years. But and the other thing we see a lot of from LPs is they're being far more specific about fund sizes, how much a GP should have at first closing, what is a viable fund for a VC house. A lot of conditions set down as to first closing amounts, and also a lot of conditions as to maximum fund sizes. A lot of LPs are more focused on making sure people don't raise too much money. I think there was a sense a few years ago people were raising far too much money, and a lot of it hasn't been spent, and there's a lot of fees being wasted on unspent money. So LPs are a lot more sophisticated on these things now.
Well, typically, from the AF's viewpoint, the key difficulty is funds that are below critical mass. And when we structure our investments, we actually have milestones whereby if they raise more than X, then they will add more people, et cetera, and then we have limits as well. But the key constraint is right now is that many funds do get to a closing, which is not the right critical mass to support the team or the strategy, with a number of issues a few years after closing.
I think it's even worse, the question of the point of convergence between hedge funds and private equity. Could you comment a little bit more on that? What does it mean? Does it mean, you mentioned debt, that is, in hedge funds investing in debt. Is there any other way there is this kind of convergence, which representing family offices I see as a whole class of alternative investments covering both hedge funds and private equity?
I think there's a number of factors here. I think you are seeing some hedge funds have got, they're really awash with cash, and some of them, to be honest, don't really know what to do with it, which is always a nice position to be in. So we might as well have a bash at private equity, in the sense of setting up a private equity division, buying a private equity house. I think that's going to be quite dangerous because it's a different skill set. Hedge funds are very good at analysing individual stocks, individual listed stocks. That's where they make their money. And they make money in a far shorter term time frame than private equity or venture capital. You see, conversely, hedge funds, particularly in, say, large public-to-private transactions in UK across Europe, being involved in this transaction, either providing some of the debt or taking positions in securities they think are going to be taken up by the private equity house. And then I also think, as a third trend, you are seeing some people trying to develop genuinely hybrid products within the one fund, within the one structure, a mixture between some hedge fund type investments, be it a fund of funds, and some underlying private equity or venture capital positions as well. And again, we've seen a few products people try and develop and bring to the market, either through private banks or family offices. And I think that could be quite risky because I think the underlying investors may not really be understanding what they're investing in, and really the risks of exposure to hedge funds and the risk of exposure to private equity and venture capital are two very different things. And to try and mix them sometimes into one product could be quite damaging if investors don't understand what they're doing. And I think that's a risk. But there's a lot of US hedge funds that have made, billions of dollars very quickly and want to sort of play about a bit, and they look at private equity and say, oh, well, we can do that as well.
Could I again just be slightly controversial and say that I believe that there is the possibility of a private equity bubble bursting at the big end. If one looks at the number of big deals which have occurred over the last year, where one private equity fund has sold an investee to another private equity fund, one has to wonder whether the LPs, and there are one or two cases where it's gone to a third private equity fund, one has to wonder, the LPs looking at the valuations in the first and the valuation in the second, valuation in the third, same underlying business, something is going wrong. And I think that's worrying.
Yeah, two questions really for Robert in particular in investing in southeastern Europe. The first question is, how do you manage the currency risk implicit in investments in places like Romania and Bulgaria? And the second is, could you just say a few words on your exit strategies when you go into these deals, what you're looking for?
Yeah, the currency risk is less than one might appreciate because as the EU accession countries now, either in the case of Bulgaria, they've already linked their currency, their lever, to the euro, so they're a 2 lever to 1 euro. Or in the case of Romania, they're turning their leu into a hard currency. They're dropping off 4 zeros within the next 5 months, so it'll be 4 lei to 1 euro. And in any event, all of the deals we do in euros, and we try to pick investees who, because of the nature of their business, their currencies and most of their costs are linked to the foreign currency. As far as exits are concerned, we look for trade buyers. We're looking for Western European countries buying market position in the developing countries. There is an argument that the Warsaw market, stock market, has got so much liquidity and is booming so much that there may be possibilities over the next 2 or 3 years to launch companies, and we're exploring that with one of our investees now.
Perhaps a comment on currency risk is that in our portfolio we have a number of US or USD or euro-denominated funds which invest in the other region, and that is creating and has in the past created a number of interesting situations vis-à-vis carry where you have an underlying portfolio that performed well, but not for the investor, and that's quite a conundrum actually in terms of, and also where you have one continental team and one UK team, for example, or one US and one European. How do you apportion carry in situations where the euro dollar exchange rate has changed dramatically?
Yes, that's a particularly painful situation with us. We're a euro fund where we were investing at 90 and we're selling at 125. So if you do actually work out our carry, if we'd have had it all in dollars, it would have been 50% bigger than it is projected to be.
Thank you very much. I'm sorry we've run a little bit late, but I'd like to thank the panel.